Nomvuyo Guma, Macroeconomic Strategist at Standard Bank, joins us now to unpack what's taking place on the currencies this morning. Nomvuyo, great to have you with us. Let's kick off on the international front and look what's driving currencies this morning. It looks like we're opening up to a picture where we've got broad-based dollar strength. The yen has also come to the fore, and the euro sitting at a one-month low against the greenback. What are your thoughts on the rising risk aversion that's taking place and playing out on the currency front this morning?
Morning, Samantha. Yes, it does certainly seem to be an environment in which risk aversion is rising quite sharply. And once again, the main reason for that is troubles in Europe and market concerns over troubles in Europe. We've seen Spanish bond yields rising quite rapidly, and in fact, they're very close to that 6% level currently. That's gotten other countries into trouble. You'd recall that 6% is the point at which Greece then had to request a bailout. So the fact that Spain's bond yields have risen to very close to these levels is causing some concern in the markets. Is also the fact that Italy's bond yields have been rising similarly strongly, and I think possibly also still the hangover from the fact that China's GDP disappointed expectations when it came in on Friday. So I think it's just a constellation of things at the moment that's got risk appetite under pressure, and as a result you're seeing this move into traditional safe havens. So the dollar and yen, for instance, are looking a little bit stronger this morning in relation to the euro and a number of other currencies.
The general view is that 7% on those Spanish debt yields is when we really need to be concerned in terms of the implications for borrowing costs and the knock-on effect of that, of the Spanish economy. What are your thoughts on the type of event risk that we're looking at on an international front this week, especially in light of the fact that we've got a Spanish bond auction later on in the week?
Well, certainly I think all attention is going to be focused on that Spanish bond auction to kind of give an indication of what demand is like, whether those yields continue to tick up. But in the background, we are seeing EU officials doing what they can to try and minimize the fallout from the situation. There'll be an IMF meeting later this week, and EU officials at that meeting are expected to ask for global assistance in shoring up the firewall and trying to get a lid on this debt crisis. So I think those two events, the Spanish bond auction and the meeting, the IMF meeting that commences later on this week, are certainly going to be the two key market drivers this week.
In the meantime, on the local front, we're also looking out for inflation figures out on Wednesday. Looking at inflation now at 6.1%. Market consensus is that it is going to come in at 6.1%. Where do you at Standard Bank see inflation for the month of March?
We actually see inflation moderating in March, so we've penciled in a year-on-year increase of about 6%. We do acknowledge that there's some significant upside risk to this forecast because, firstly, March is a high survey month, but also you're going to have the effect of all of those excise taxes that were announced in the budget coming through in that month as well. So while we acknowledge that there is some significant upside risk to the forecast, we've seen some fairly benign CPI prints coming through recently, and we think that that's evidence that these generalized inflationary pressures might be a little bit more benign than initially thought. So we're confident that we'll see inflation subside and head closer towards the upper limit of the target ceiling rather than continue to accelerate.
That's an interesting view there, and as you say, looking at all the added costs that the South African consumer has, we see that e-tolling also coming online here in Gauteng in 2 weeks' time. That's a very contentious issue right now for anyone who lives in Gauteng. But what are your views on the risk that this weaker rand poses to the inflation outlook right now? Just dipping below 8 rand this morning, but we have seen a bias towards weakness over the past while.
Yes, absolutely. And in fact, our base case scenario is for the rand to continue to weaken over the medium term. So certainly when it comes to inflation outlook, the fact that the rand is weakening is of some great concern. But again, I don't think has reached levels that would necessarily cause a spike in inflation. So at the moment, we're still very comfortable with our inflation forecast. We see inflation still receding. Of course, should the rand weaken dramatically, we're talking levels of 840, 850, then that's certainly going to have a material impact on our inflation forecast. But at the moment, the risk, we're judging the impact to be relatively marginal if the rand, for instance, depreciates to about 810, 820 in the short term.